Hello, founders. Welcome to Startups.com. We are live. We're coming to you every Tuesday, Wednesday, and Thursday. Tuesdays, in case you didn't know, we do pitch decks every single Tuesday. Wednesday, we do traction hacking, revenue acceleration. And then Thursday, which is today, we go through your most asked questions and we just go through lots of great topics of conversation. And if you're in the audience right now, we encourage you ask a question, put it in the Q&A box or chat to ask that question. We are definitely happy to answer that. If not, today, we're going to be talking about how to navigate an investor recession. This is, I think, an important topic, especially today. We're talking about looking at the markets. This is going to affect us. But I also want to just quickly state that this show is brought to you by us here at Startups.com. If you haven't checked us out yet and you are watching us on the interwebs on YouTube, make sure you like, comment, subscribe, share this video with a founder who needs it. A lot of free resources on Startups.com. You are the CEO, founder of Startups.com. You've done 9 startups. You've exited 5 times. You've got all the experience. Why should founders come and hang out with us here at Startups.com?
Ed, I actually just hung out with a whole bunch of founders on Thursdays. Before this, I do office hours. So I do 15-minute calls back to back to back, and sometimes I'll do 10 or more calls in a row. I just got off those calls with a whole bunch of founders. And I think the most consistent thing I was thinking while I was, trying to help them out, all different businesses, et cetera, is what really helped, I'm curious how you think about this, is just to get this out of your head. Whatever problem you're working on, it could be a co-founder issue, a pitch deck issue, whatever it is, you're banging it around in your own head. You're not getting a lot of progress in a lot of cases. And then you put it in front of someone else, a stranger, in our case, a startups advisor, right? Or even another community member on the platform. And you're like, oh, as soon as I said it out loud, it absolutely made sense. It's why people do therapy. Most of therapy is just saying things out loud.
Oh, yeah. I've done a lot of therapy, Will.
Yeah. And a lot of that is this. So when you're coming to Startups.com, when you're talking to people in the community, when you're talking to people like me and Ed, part of this is just getting stuff out of your head and being able to do it in almost like a confessional level environment where you can be like, I don't even want to admit this is true to anybody, including my spouse, but here's how I'm actually feeling, or here's what I'm actually dealing with. And be able to talk to people that totally get it, that are like, yeah, I've been through this, and or I've coached 1,000 other people through it.
That's just the thing. We totally get it. And often you discover what you didn't know. And then you're in a safe environment to acknowledge that, because sometimes maybe you don't really want to talk about it, or you don't feel as safe in other places. But we just want to make it as safe as possible for everybody to discuss.
Yeah, exactly.
Let's talk about what we got going on today. I think this is a very relevant topic, Will, right now, and it's how to navigate an investor recession. And I would say, Will, 80% of the founders, the majority of founders, are coming to us and they're raising money in some form or another.
Yeah.
And and we try and help you generate revenue, but investors are a top of mind topic. And Will, you put a really interesting post on Reddit. You can all check us out and hang out with us on the subreddit, our startups. But Will, you called it an investor recession. I thought that was a really interesting term. Define that for us. What is an investor recession?
I don't even know if it's an actual term, but here's why I called it an investor. It is now. I just called it. Every word or phrase isn't a word or phrase until somebody makes it up. So damn it, I just did it. But here's how I was looking at it. In my mind, in my purview, from what I'm seeing, some of the data is a little bit contradictory in some cases, but I'm seeing a massive slowdown among investors. But I'm also not surprised by it. What I posted in that post on Reddit was that the reasons this is slowing down aren't insignificant, and they're not hard to track. Here are some of the things that I said, and this is why I'm seeing this kind of like mushroom cloud develop. The first was the markets, being like the stock markets, have actually done surprisingly well in the last few years. Right? So like if you're investing in the S&P 500, for example, even just in an index fund, you might have been able to see 20% returns, which is incredible. So when you're seeing that kind of return, where you're doubling your money, if you will, every less than 5 years, it's kind of hard to say, let me take that money that's just printing money and put it in a super high risk startup that I'll probably never get my money back. Okay. Now that's just one reason. Second reason is interest rates. This is in the US I'm talking about, but interest rates have been crazy high for a really long time, which prevents people from being able to borrow, prevents people from investing. Oh, you got some of the things here. Okay, great. And so the next one, right from the top there, is VCs are coming off of what has to be the worst run of IPOs of all time. And I think we're like 3 years deep with jack shit to show for IPOs.
Yeah, it's been so sparse, kind of scary.
Yeah, and so that's how VCs make money. And by way of that, that's how angel investors who then move on to VCs, as far as those successive rounds, make money. We make money because somewhere along the way, some of us startups, the fortunate ones, are able to exit for these massive amounts. And the big thing is IPOs, initial public offerings on the stock market. And we hardly ever see them. The great white hope was CoreWeave that just went out. had actually a decent IPO, but I saw it today, well, everybody, but it's down like 17%. That doesn't inspire a lot of greed. When you're seeing, if you're a VC and you're seeing every one of your counterparts at every firm make $100 million every other week, you are like, I need to write checks. When you're seeing every one of your counterparts get crushed in every portfolio company you wrote checks to doing down rounds and getting crushed, the last thing on your mind is, how do I deploy a lot more money? So I think we've got all of these factors that play in at the same time, Ed, and it's making it really difficult for investors to be investors. They're scared. I mean, if you just call it what it is, the investors are scared to make startup investments.
Let's talk about that. We're in a unique situation with the AI. And if it's not AI, it was something else through the previous cycles. And we'll talk about this in just a moment. But specifically, let's break it down, because AI was supposed to be, real big, just as other trends are supposed to be really big.
Yeah.
But what dynamics are you starting to see? Because I see some really interesting ones occurring.
Ed, at a high level, I expected there to be more. Like, I expected 1999 internet level of investing, right? Just absolute frenzy. And look, at the top, if you're talking about like the equivalent of CoreWeave, but more specifically like a OpenAI, ChatGPT, like that kind of thing, Anthropic, yes, those folks are crushing it, okay? At the top of the market, OpenAI, I believe just a few days ago, raised the biggest round in history, $40 billion, right? A single round. Most companies, I remember, Ed, if we go back to the WeWork days, when WeWork was doing like just stratosphere, like no one had raised that much money at those valuations, et cetera, and they raised $10 billion, no one could even like wrap their head around it. It was like so bananas. These guys just did a $40 billion round, but it feels like the money's concentrated at the top. What's your take on it?
Well, okay. So you combine these factors, and everybody, just as catching you up here, we're talking about these factors that are contributing to what Will has affectionately referred to as the investor recession. But you combine the cost of borrowing and capital, and so now it's expensive. And then what I've seen talking to investors and listening to these general partners, they have to go get their money into these big plays, because their LPs are putting pressure on them and saying, if you're not in one of these big plays right now, then why are we putting our money with you? So that's the reason there's been this rush and there's this inflation, and all the oxygen has been sucked out of the room. And dare I say, creativity, a little bit of people thinking, okay, let's look in the long tail or be a little contrarian. It's been the biggest trend chasing that I've ever seen. Will,
I get it. And so, like, the thing that you and I see, we see a gazillion pitch decks. So because we help a ton of people raise money, and what we see is AI everything, right? If you have a dog walking business, it's now powered by AI. And so you have lots of people trying to use AI, but very few people actually building AI, if that makes sense. You have very few open AIs in Anthropics. You have a million people building a wrapper on top of that product.
And let's be fair, whoever wins. So I figure, there'll be 3, maybe 4 major players. We're talking the next $1 trillion companies. It'll dwarf
absolutely
everything else. But there'll be so much loss. Like, it is the fastest depreciating asset if you're in the wrong thing, just as we're seeing all this money get pumped into OpenAI, and then a Chinese company, DeepSeek, which I question because I lived in China. I know how all the optics work, but they came in and they really rattled the entire industry. So it's a dogfight because the stakes are so high. And I think, Will, all the investors, the entire ecosystem is kind of waiting to see how it shakes out. Really what we need is we need one of these AI companies to go public and go massively nuts. And then I think the froth starts over.
You bet. And so that's why CoreWeave going out within the last week was such a big deal, because that was supposed to be like one of the big ones. Now, there's some other folks that are waiting in the wings. I know StubHub's waiting in the wings. I know there's a few others that are like ready to go out. Klarna ready to go out, but they're not, right? If this was 2001, they would have all gone out in 5 seconds, or 2021, they would have all gone out in 5 seconds. It was the frothiest IPO market ever. But the challenge is we get into this situation where the people that do go out get shot down immediately. I mean, like, again, CoreWeave could not have picked a worse time to go out, given that Trump just announced all his tariffs to the world last night. So everybody lost. I saw the CEO of Restoration Hardware on a call. This morning is on CNBC on a live call, right? And while he's sitting there, he saw their stock price go down 46% while he's sitting there. Can you fathom that? Like 4% would have been, oh my God, like I gotta get off this call and do, whatever I gotta do. 46% is like our company just went out of business while I'm on a call. And so my point is with CoreWeave, they went out at the worst possible time, right?
On top of which, Will, we just saw one of the initial darlings, 23andMe. Their belly up. So you combine all this really bad news. Now, here's the other thing. Well, I don't think a lot of founders think about this, is as soon as you start seeing it, like You look at Warren Buffett. Here's a guy
Yeah.
that I track. I like to know what he's doing, right? Keep my
Yeah.
finger on the pulse. He's stockpiling cash. He knew something.
Yeah.
And so now all the investors, they're going to get in the market. They're not going to get in startups. They're going to go and snap up these deals because everybody knows this goes in cycles,
Everything just went on sale.
which is great if you're that type of investor. As a founder raising capital, we're going to talk about these challenges. And once again, everyone, get your questions ready. If you got questions, let us know. We're talking about how to navigate an investor recession. We just went through these factors. Bill, let's talk about this just for a moment.
Yeah.
How many times have you gone through this? Let's just put this into a bigger picture context.
Will, why are you so old? So I started my career in 92, 93, started my first company in 94. So I was coming out of the tail end of the early 90s recession, but I wasn't like at a point where I was raising money or anything else like that. So I didn't experience that. I was so fortunate, and you got to call it what it is. I was very fortunate that I started my first company in 1994. I started one of the first web design companies. Like, talk about timing. I'm building a website company at the time when everyone in the world needs a website, right? Like, amazing. So through that time, up through like 1999, and it didn't occur to me that I didn't know what a layoff was, right? I'd heard that people got fired, but up until that point, it made no sense. We had just hired 700 people, right? The only time people would leave is because they got a better job offer somewhere else, right? Which happened all the time. So then 2000 hits, right? 2001, stock market implodes, bubble bursts, etc. And for the first time in my life, I got to see firsthand what this is like, what a extinction level event is like. And Ed, I'm sitting at my desk, I'm running this ad agency. We've got $10 million a month worth of payroll at the time. Okay, $10 million a month of payroll. Okay, so a lot of mouths to feed. And I get a call from a client. This is the first call I got. And they were like, hey, you know that $4 million that we had earmarked for the project next year? I'm like, yeah, of course, we're excited about it. Like, yeah, that just got canceled. I was like, oh man, that doesn't happen very often, but okay, right? Not the end of the world, not great. A lot of money, right? Next call. Hey, Will. This is like hours later. Hey, Will, you know that one project that we had earmarked for whatever? That's gone too. These are all massive Fortune 500 companies canceling on us left and right. And I was like, what's happening? I'd never seen this. Now, the reason I bring up this story, Ed, is because you got to remember, we have generations of founders who have never seen this. They saw COVID, which was a bizarre opposite effect.
Yeah,
2021 was the best year of venture of all time.
It was like a parallel universe opened up.
A parallel universe, right? We literally bent time, right, in the form of interest rates. But you now have a very big cohort as far as age range of founders, Ed, going into the market being like, I don't understand what's happening right now. We got to appreciate that. I've been doing this through like 3 of these. I'm used to the boom bust cycle, but I'm telling you, when I hadn't been through one, like a lot of the founders are right now, I was a deer in headlights. I had no idea what was going on or why.
I had a founder ask me that. She said to me, Ed, you seem so prepared for what's going on, because I was explaining how I've stockpiled cash and made these decisions. And I said, this is not my first rodeo there, and my story. So my first startup, 97, I sold it in 99. Then I went, Will, and I did 6 .coms in a span of like 2 years. And then 9/11 was the big implosion for me. Everything went nuts. Yep. I was in the US during 9/11. People are out on the streets running around shrieking. I said, I got to get out of this country. I need to get back to Canada. Took me, gosh, I don't know how long. I think 6 weeks, something like that, to get back home. It was an exaggeration, 10 days to get back home. And then I lived through subprime mortgage meltdown. We had a startup funded. I watched Fannie Mae or, those companies. I watched the whole thing. You watched those movies, Too Big to Fail, The Big Short. Yep. I lived through that Obama administration. I watched our stock price tank, millions of dollars wiped off the cap table right away. And then I lived through multiple implosions. And then I thought COVID was going to be the implosion, but like you said, the opposite happened, and it created this bizarre expectation that everything just gets funded in 30 days, and everybody's going to make you money, and startups became the coolest thing to do. Yep. And guess what? Now I dare say we're back to kind of normal in how we should expect it to go.
Well, I think it's a couple things too. I think part of it is we are in a recession, so to speak. I mean, in the US, we might actually wind up in an actual recession at the rate we're going, but we are in a startup funding recession. In my mind, in my purview, there's others that would say otherwise, but I don't think anybody's saying that it's a crazy go-go time. I think it's not just the investors, it's the startups. Ed, most of the startups I talk to right now are in trouble.
Yeah.
Right. And I'm talking well-funded, like hundreds of millions of dollars funded startups, not just like, somebody raised 500K. 500K, you're always in trouble. There's no way around it. Right. But you think when you've got hundreds of millions of dollars raised that you're clear. And these folks are actually taking the biggest hits because they raised that money 3-4 years ago in the frothy times, and they needed more of that money to keep going. And it's not there anymore.
Yeah.
And that's a big problem.
they had that expectation. So, in 2023, billions of dollars are wiped off, just wiped, like Armageddon.
Yep.
It is a
Yep.
mass extinction event. And literally my A round founders who raised an A round because they did so well, hyper growth
Yeah.
through pre-seed seed, they got their A round and they just burned through it because that's what they were supposed to do, getting phone calls from their VC saying, you now need to know how to survive.
Yeah.
And
right. Polar opposite call.
Just absolutely insane.
Spend it all, save it all.
Exactly. And that's what I don't think founders really understand how quickly things can turn.
Yep.
And therefore, playing that game and thinking that, oh, I'm just going to get funded and rocket through A, B, C, D, E rounds and then go public. It's just not the reality anymore. So
Yep.
let's talk about that, Will. Let's talk about what are the things and base it up on the cycles that we've experienced. So what will make investors come back? What are the signs that us founders should be looking for in the market?
Yeah, let's talk what to do about it. Within that, what gets investors excited? You always wind up going back to fundamentals, right? Where they can invest on hype, now they're investing on revenue. Now, to be fair, when people say that, I don't think investors at large, especially at the earliest stages, the pre-seed and the seed, where you're raising like 500K to a few million, I don't think investors are expecting lots of revenue. How could you? The whole point of raising money is so that you can start to build these mechanisms to make money. However, I think that the idea that this startup has no path to revenue at those stages is a giant red flag, because they're now stuck with all of these legacy investments where they poured hundreds of millions of dollars into that didn't have a path to sustainable revenue. And it's just gone horribly. They've been in countless board meetings at this point for 3 years straight, Ed, right? Where at every board meeting, they're like, we're so out of money. We didn't measure up to what we thought we were going to do. It's really hard to come out of all of those meetings and be like, yeah, let me put some more money in a company with no path to profit or no path to revenue, right? Doesn't make sense.
Let me pause you for a moment there, Will. Everyone, it's not that these GPs, and I've sat on that side of the table, it's not that these GPs want to be mean and pinch you off. They know you need the money, but quite often what happens is the LPs are not reloading. And that's what we saw. I saw a stat that there's 75% less capital in the market over the past few years. So even if the GP or whoever's investing in you wants to put in more money, they may not have it to put in because everything has jackknifed, like just everything's flown down and ended up on their laps with you needing money, them not having money, their LPs looking at them sideways, and them figuring out, man, how do I even raise another fund? Because that's my life stream. And that is what happens in the VC market.
A great sign of the times was a friend of mine named Sar Gur. He partners over at Charles River Ventures, very famed and well-respected venture firm. They were in the news not too recently talking about how they gave the money back, which you never hear about, right? It takes so much effort to raise a fund. We're talking hundreds of millions of dollars, and they gave it back. Wow. That doesn't say it all, right? And CRV, Charles River Ventures, has been around forever. I have no idea how many funds they've raised in their lifetime, but that has to be, and they're one of the oldest, most storied firms. It has to be tons of funds. So for them, they're the kind of fund that's been so good and so reliable for so long that they could take a beat and just kind of sit on the money. And enough LPs, limited partners, have made money on them for so long that maybe they could accept it. But even a fund like that is like, we don't know how to deploy it. We're sending it back. That is not a good sign. Now, again, I think sitting around and complaining about how much investors, aren't investing or how scared they are isn't useful, right? It's useful so that you understand the situation as it stands, but you still need to raise capital.
Yes, you absolutely do. Okay. So that's the next question, Will. And I know you're segueing into this.
Yeah.
You still need to raise capital. And what do we then need to do to make that happen? What should we be preparing to do?
Okay, so first things first, I think a really important distinction between then being a few years ago and now, I think, again, we need a path to revenue, not necessarily profit, just income coming in, right? Whereas before we might have been able to spend a few years gathering user demand or building up customers. I just don't think that there's the same appetite for that. My favorite was, we'll figure out monetization later. I was like,
I remember that one.
It's called being a business, right?
Yep.
We're hiring a chief monetization officer. Wait, hold on. You started a business, but you're hiring somebody to tell you how to make money on a business? That's literally what a business does. The fact that you need to hire somebody to figure out how to make money is the biggest red flag I could possibly fathom.
Let me double click on that because so many founders, they cite the example of Facebook. Facebook made no money till Sheryl Sandberg showed up.
Yep.
Then we're also talking about Amazon. They were made no money for the longest period of time.
Well, they made no profit. They
Oh
made
yeah,
lots of
okay.
money.
Exactly. And I remember the big thing was they turned off all their advertising and they said we're going to put it into like free shipping and everyone thought they're stupid. But they had the scale. Uber, another example, not being profitable. But yes, you saw people stay in the world where freemium, they said freemium. We're going to do freemium, which meant I'm not too sure how they're going to pay us money, when they're going to. We're just doing free and this is our intention, and we saw that happen a lot. Gather as many eyeballs, especially during .com 1.0. I was guilty of that. I helped a
Yep.
lot of companies get a lot of eyeballs going, a lot of impressions, made no money, and that's what made everything implode. So you're saying, well, right now, that's going back to basics. Like that's table stakes right now is generating revenue, and that's what founders should focus on.
I think it's silly that we even have to have this conversation, right? that we actually have to sit down and remind people that they should build businesses that generate revenue, right? I mean, it goes to show how far off the reservation we've gotten when we have to come back and explain the fundamentals. That's like me telling my kids that they need to go to school to learn. Like, why else would they be there, right? That's literally why you're there. But to take it a step back, we were able for a very long time to transpose what should have been customer revenue with investor revenue. So for a long time, we were to say, we don't need customer revenue. We've got investor revenue. And that was real, right? Like you really could expect for a period of time for investors to essentially make your payroll.
And that's where you got professional founders that were amazing at raising capital. And really, that was the one trick pony, but they were really good at it. You could argue like Adam Newman, he was really great at raising capital, really good at playing that game. But yeah, I saw founders and they were raising round after round. Like it was their professional job. That's all they did. And they were good at it. So yeah, their companies could survive.
To be fair, you also got wildly rewarded for it at a lot of different levels, right? So on the one hand, if you did it particularly well, the other Travis, not Callan, Travis Vanderzen, I can never pronounce his last name, who did scooter company.
Bird? Was
Bird?
it Bird?
Yeah, he did Bird. He came from, if I recall, Uber and Lyft. He went and he started Bird at like the perfect time. Now it wound up being the not perfect time because it wound up being right before COVID. But my point is, if I recall, and again, this was grapevine, it might be true, it might not be. He took 40 million off the table personally in just raising money, right? So this is what I meant by being rewarded. There were some instances, not all, but there were some instances where the founders were being financially compensated handsomely. Adam Newman probably won the lottery, the all-time lottery on that one. Jamie Dimon from Chase Bank approved a $500 million line of credit to Adam Newman, okay? This is a guy who had never turned a profit. And the world's leading banker, like Jamie Dimon's an absolute war beast, right? That guy's amazing. In other words, he knows his shit. He's not like people pull the wool over my head. He approved a $500 million line of credit, not to the company, Ed, to Adam personally. So he could buy like 20 houses. My point is, as Adam's out there and he's raising, okay, he's getting significantly rewarded for raising the way you're supposed to get rewarded for making money, right? And there was a time, a good 18-month period where that money was good, you know? And so it's hard not to say like, hey, I guess that's my customer.
Let's look at the flip side of it though, Will.
Yeah.
Is we know lots of companies that were born and raised during these recessionary times, and they are much stronger now than they've ever been. And you hear this, the best time to start a company is during a recession because you're so much scrappier, you're so disciplined, everything's working against you. Therefore, you're stronger right out of the gate.
And the world's on sale, okay? So if we rewind back 3 years ago, Ed, what was the premium you would have to pay to hire a React developer 3 years ago? Okay. Now forget that AI is like eating some of that up. It was bananas. In my WhatsApp groups, where I've got a bunch of other founder friends who have, raised a bunch of capital, when we would compare notes as to what it costs to hire like, developer, whatever, one person would say, on average, I'm paying 180K. And mind you, this is like Midwest. So this isn't even like the coast. Another guy's like, how did you get away with paying 180K? I'm paying on average 220. Another guy would say, I would kill to pay 220, right? I mean, that's how bananas it had gotten that we couldn't even benchmark.
On top of which, the headhunting fees, the referral fees, and then all the perks that you had to pay to make those engineers happy, all the benefits. Oh, it was a total employee market.
Well, so that being the case, if you're a founder and you're at the bottom of that food chain, right, where you have no money and you're trying to recruit developers and you're trying to get people to work with you, et cetera, and you're like, oh my God, table stakes now to get anybody is so incredibly high. Okay. It was that way before the boom in our bust in 2001. It was that way before the financial crisis. Financial crisis was a little bit different because it didn't affect every industry the same way, but I went through it and it sucked. But in each of those, we get a reset. We're getting a reset now. Okay. I'm getting, for the first time, people hitting me on LinkedIn, on Reddit, and all these places that are React developers that are like, hey, I'm looking for work, right? People who wouldn't even have returned a phone call with a firm job offer a few years ago. Now, this isn't me being happy about them having to look for work. I hope they find it. What I am saying is the market is 10x cheaper than it was before, and that is a massive opportunity for this next round of startups to grow up in.
There's a lot of talent that's definitely hit the market. You know, the technical co-founder, Will, 3 years ago, used to be the mythical unicorn that you'd have to like sacrifice virgins and you have to do some type of magical ritual and you have to be all these things to get a technical co-founder to come because everyone's building the thing. But Will, right now, there's a lot of technical people looking for gigs. It's a great time to snatch them up.
Yeah, and look, it's everything. It's with the cost of marketing. When everybody is spending huge budgets that they just minted 5 seconds ago from a big raise, all your CPC costs go up, all your partner deal costs go up. It's crazy. When all those things start coming down and those budgets start imploding like they are, then things start to get cheaper again. So it makes business models that maybe just didn't work because they were at the wrong place at the wrong time really effective.
We are talking about, okay, what will bring investors back? We need some cycles to happen, IPOs, make it frothy again. Yeah. And then what we should do, you said focus on revenue. I think our talk just recently, everything we just discussed, it's all about let's be scrappy, let's be capital efficient and take advantage how everything is like 10x cheaper. Great opportunity. What are some other things you think founders should be doing right now?
I think it's more around just saying that I'm going to build a business that's going to sustain with or without capital, okay? Whereas before, I think because capital was cheap and it was prevalent, it was, I'm gonna go raise capital and then build a business. What I see now, and we're looking at seed strapping and, kind of other terms that are starting to bubble up, I think we're seeing more people saying, well, I'm just gonna build a business. It might raise capital, but I'm building it either way. And I think that is a very healthy way, frankly, always to look at a business.
What I'm also seeing is that founders who understand how to get distribution going, so develop channels, especially in this real fragmented, wonky, all over the place. Like you've got so much noise that's going on. The founders that are able to do that, I think also have an advantage because they're showing anybody can build. Like we already just said, technical talent is out there. Let's go build some stuff. I see dev shops like founders or technical people get laid off from their job. So let's go open a dev shop. Now build your MVP and all these things. It's all over the place. But the founders that can figure out how to hack distribution for less money, I think are having an advantage.
I feel like it's always distribution or customer acquisition that wins out in the end, right? Initially, you can build great technology. You can be like ChatGPT, et cetera, but you still have to be really good at customer acquisition. Apple has good technology. You could say great technology depending on what the product is, but they have phenomenal customer acquisition. Like their ability to generate buzz and in conditioned markets is second to none.
The value of their bread, definitely up there.
Yeah. So with that said, I think as far as how startups are looking at the market right now, as far as how they're thinking about how to differentiate, et cetera, I think the biggest thing is, what can I do to get real product in the market to generate real money, even if it's a tiny bit of money, right? Or even, here's the thing, even Ed, if it's not exactly what the product will ultimately be. Did you know that Tony Hsieh is not the founder of Zappos?
Yes, I knew that.
You knew that, right?
Yeah.
It's Nick, can't pronounce his last name. In 1999, Nick, who started Zappos, Tony came in later and as an investor. In 1999, he wanted to start this business. And as he was doing that, right, as he was trying to think out how to start the business, he had no money. So what did he do to start Zappos in 1999 at a time when like selling shoes online was unheard of?
Great story.
He went around to shoe stores. And by the way, you didn't have a camera on your phone. So you're going like old school digital camera or a regular camera. And he's taking photos of shoes at shoe stores and then putting them on marketplaces, think like eBay, stuff like that, in order to sell them as if it was his store, okay? People would then buy them. He obviously doesn't have the inventory. He then go to the store, buy the size of shoe, and then ship it to them. Now, you may look at that and say, well, that doesn't scale. That's not sustainable. You can't make money in that. No, you can't. But you can generate revenue, and you can prove that there's demand without having to buy a single damn shoe, right? I love that scrappiness. And I always say, what is the version of the product that isn't the final version, that's some weirdo version that we can put together now with no money to start talking to customers and putting something in front of them? Ed, if you and I wanted to start a bakery, it'd be the worst bakery ever, but if we want to start a bakery, I would say let's not try to raise money to open a bakery. I'd say let's start baking some stuff and show up at events and see if anybody wants them. Let's host cocktail parties and see if people at the party love our product. I don't see enough startups with that level of hustle and grit, but that's what investors want to see. They want to see you already got into it. You didn't wait for the money.
You are going to stand out so much, especially when everybody else is like, hands out with a check and saying, I need the money before I can begin, you're going to
Right.
set yourself apart. And that brings us to these next points, Will. We've got some really great advice. The question is, and I see the founders in our audience, they're trying to raise money. So we're
Yeah.
going to give you some practical things. How do I stand out when everyone's chasing the same check? We just talked about there's more demand for investment than there is supply right now. That's just straightforward, first principles. So the first thing that you say is showing real traction, meaning you didn't just wait for the check to start billing. We just discussed that.
Yep.
And Will, I want to pause this just for a moment. What you just said is not just during recession times. It is actually during every time. I think about some of the newly minted unicorns from 2024, and they just started off with like something manual, an email newsletter. Let's try it this way. So this principle is for every startup in every environment. It's not just during these recessionary times that you stand out with traction.
Right. Of course. Always. Traction's always there. But in this case, traction means the actual business and not the promise of a business.
Perfect. Okay. So then next, you say being buttoned up, strong pitch deck, meaningful demo. What does that mean?
Ed, you and I see a ton of pitch decks. Now, this is nobody's fault. The versions we tend to see initially are awful. Now, again, the reason they're awful is not because the founder is awful, right? So I'm not like picking on any of the founders. They're awful because they need lots of revisions, right? Just like that's the nature of a pitch deck. It's like raw clay. You have to keep molding it until you get that beautiful artwork at the end, okay? But most founders just don't know how that process even works. They download a template, which is the worst thing you can do, and they try to retrofit the template with their words, which is like downloading a book and trying to rewrite a book using the words that are in the book. It just doesn't work. And what they come up with is kind of a janky deck. It's missing a lot of key points. And when they send it out, investors are like, you can tell in 2 seconds. Ed, I know you can do this. When you get a deck, in 2 seconds, before you get even past the title slide sometimes, you can tell the maturity of this founder.
100%. And you say this all the time, but we're conditioned. Let me back up. I told some founders, and this is pretty hilarious. I don't know if you ever did this, but Will, every time I pitched an investor and I was on camera or somewhere, I always wore a hoodie. Okay. Every single time. Why? Because that was pattern recognition. That's just what investors were used to. That's what successful founders look like. And so I said, I don't want to risk the chance of wearing something that someone doesn't recognize. I wore a hoodie. Now translate that to pitch decks. We've seen so many pitch decks, Will, that pretty much we can predict right off the cover slide what we're going to see. Rarely do we get surprised because we've been conditioned over and over again with those signals that have been ingrained into the subconsciousness. We literally have neural pathways trained to recognize these pitch decks.
Well, that's the thing. And so as an investor, when you see a deck where you can tell it's not buttoned up, like an advisor or someone with pitch deck expertise or fundraising expertise has not looked at this deck or has like guided this founder. And it's most of what you see, to be honest, right? Like most of what you see are fairly unconditioned decks, so to speak. But the moment you see one that's you could tell this person's been coached, it's not even remotely close, right? Like it's so much better than the other ones that you see. And you know that, yeah, maybe you're not going to invest in this, but you know immediately that that is the first product that this founder has shipped is their deck. And they were good with it and they were smart about how they communicated and is an absolute reflection of who they are as a founder.
And when investors see that, so many signals go through that. One, you're talking to other people. Two, you're not living in your own bubble.
Right.
Three, you can be coached and you might have a good relationship with that founder. There's so many things that go through an investor's mind. And not to mention, you're not creating that friction that they are willing to go through the rest of your deck, because if you don't do that, you risk so much in not getting even right through the front door. And that's where today, I think it was today, Will, we were doing a cohort and a founder said, oh, yeah, I know what I want to say in the pitch deck. I was like, okay, there are things that I know you want to say. And then there are things that investor wants to hear.
Yeah.
How well do you know what the investor wants to hear? Do you really want to take that chance? Please, for the love of God, let me take a look at it. And that's what you mean by getting it all buttoned up. Just be safe and make sure that if you're going to fall flat on your face, you do it with us, me and Will. You'd rather do it with us than lose your shot. Here's another thing. Will, I had another story today. We have a really great founder. I don't want to call him out, but man, he is on top of his pitch decks. He sent me his first pitch deck, Will. And you're going to love this. And I was like, this is a really great pitch deck. For the first time seeing your pitch deck, I'd never seen anything. I was like, it is bang on. And then he says to me, no, Ed, I've gone to Will's classes. I watched all your stuff before I sent you the pitch deck. But I was so impressed. And then we went back and forth and we just hit it. And our sessions were so productive. And literally, he told me an hour from now, he did a last check. I have 2 investor meetings that I got because my initial deck was strong. And now I'd gotten to the second stage and I was like, this is what we're talking about. That's what gets me pumped, Will.
I agree. Actually, I talked to the same founder a couple hours ago. But the deck, solid, right?
Yeah.
You can tell, right? A good product. So what I'm saying is, like, a good deck matters even in a frothy market where it's slightly easier to raise money. In a recession level market, as I'm calling it, it's absolutely critical because your competition is just at another level. The other thing I mentioned was a meaningful demo.
Yeah.
All I mean by that, I don't mean build the whole product. That's definitely not what I'm saying. I'm saying just something that shows what this thing is, right? It could be just a bunch of screens that you put together, right? That's fine. It doesn't have to be a working, a taste test, a single prototype if you're CPG, right? Just something to show that you've taken things a little bit further.
Here's what I recommend. If you've gone out, and we've done so many videos, and I think we're going to beat this drum till we're old and retired, Will. I'm going to be, in my wheelchair sitting beside you. We're going to be talking about the good old days we did this stuff. But if you've already gone out and you generate revenue and you've done a business, you have so much that you can demo, even if it's just like we did this for this customer and that customer.
Yeah.
Check out these social, proof in terms of the logos. So getting the traction ahead of time as fast as possible, even if it's just talking to customers and letting investors know what they've said and showing them what you showed them, you showed the customer, that's a solid demo.
Agreed. I think for a lot of folks, again, they think it has to be the final product. It has to be the brochure of the product. Like, this is what the product would be if it were built. It's the model home of products.
Literally, I think, Will, you said brochure. One of the demos that I do is I'll write a book. I'll write the manual on how it's working. And people say it's legitimate. If you're willing to put the time in the demo, think about, actually, let's back up. Another story. Investor said, no, I'm not interested in this founder. He's telling me the story. Not interested. It doesn't quite solve the problem. Don't see the market. But if you solve this problem and you did this little iteration, all right, then I'd be interested. Next week, they were in that office giving a demo and saying, this is how fast we put it together. And
that's
they were
the
like,
idea. That's what I want to see. Yeah.
Those are pro tips. All right. So then let's get to the last point. We can squeeze this in here. The last point is being way more persistent about tracking down investors.
Yeah. So here's what I see. And I know you see the same thing. We'll talk to some folks where we're coaching them through the fundraising process, and they've got a list of investors that are like the perfect target list. And we'll say, okay, how many folks have you reached out to? Like, well, I reached out to 5. Okay. That's good and bad. Okay. Good is you didn't find an investor list that you bought online from Upwork for $25 and you BCC'd all of them in caps saying amazing investment opportunity, right? Like,
founders do that. Yeah.
God, that works never. But the other side of it is, great, you emailed 5 investors. Then what? Well, I'm waiting for them to respond. Like, you're waiting a long time. It's nothing you've done wrong. You forget that the customer you're calling on, and this is a sales process, the customer you're calling on, the investor, is getting pounded by lots of other people doing the same thing. It's not like they're just sitting there waiting for your email to come in, reading it thoroughly and thinking, how will I proceed with this investment? If you say, hey, I'm an investor, Ed, you've been in this seat. Everyone wants to talk to you. You're the most popular, good-looking person of all time, right?
Yeah.
So the persistence means if I send out an email and I don't get a response, well, then maybe I'm going to go over to X/Twitter and try a DM, not the same day, maybe a week later, right? Or maybe I'll try them on LinkedIn, or maybe I'll try somebody else at the firm because that person's not responding. I don't want to be a stalker, but if I send out one email to a firm and get nothing in response, it means I probably should try again. Now, if I try a few different ways and I get nothing, take a hint, okay? They are under no mandate to respond to you. It's like when people apply for jobs, they never told me why they didn't accept my job application. They're under no mandate to do that, right? Their job is to hire people.
Okay, but hang on. Let's back up for a second because, I have founders who are pretty darn persistent on every social media channel that I have. And they're hitting me up for everything from money to referrals. Back it up. And this is just a request for all you founders out there. Before you reach out, just like the pitch deck, work with us on how to reach out. We have a really great course on Startups.com on how to write the outreach email, contact and get involved in those conversations. Will, one story that we had, we know this founder and he's, raising capital. He's been with us for a while. And he said, Ed, I joined your LinkedIn posting parties and there we comment on each other's stuff. And so we teach how to comment and get someone's attention.
Yeah.
And he said, if I didn't know how to do that, I wouldn't have commented on a conversation between a founder in my industry close and their general partner. And then I got in and they responded to me. And then they both sent me an invite to be a connection. He said, I never would have done that if I didn't understand how to do it. And that's my encouragement for everybody.
And so all I'm saying is you've got to understand your customer in this case, again, customer is the investor, is being chased by everyone. So the fact that you sent them one email and didn't get a response back should mean absolutely nothing. Again, this isn't the same as send them 500 emails or send them an email every day. It just means try a few different methods before you exhaust that connection, but understand that everybody has a different way in timing, right? You may have emailed me on a day where I'm closing a huge deal. So I ignore your email. And the moment I ignore your email, there will be 100 other behind it. Right. So it's not like your email comes in and I just have it sitting in my inbox and I just can't wait to get to it. Like, unless I feel like I need to respond to you at that moment, it just goes away. A great way to think about it, Ed, is your social media feed. You don't go 2 weeks back across your entire feed to see what you missed. Right. Yeah. Like, if it didn't hit you at the right time, it didn't hit you. You just move on to what's current. Investors have that luxury. So you've got to understand who your customer is.
Here's something else that you sparked with this tip here in being totally persistent. I think that founders don't follow up enough. Let's say they have the meeting and then you ask the question, hey, can I keep you posted and send you investor updates? And a lot of investors will say, we put you on a list, or they don't tell you, and we just want to watch you for 6 months.
Yeah.
And a lot of investors say, I won't even begin to touch or explore until I get 6 months of investor updates. And therefore, it goes all the way back to what you've been saying, Will. Work on your startup, generate revenue, get in the game. So you've got inflection points, you've got good news. So you can say, hey, remember I presented to you and we were pre-revenue. We just got our first paying customer. And then a month later, hey, we are growing, 10% month over month. And then you contact them again, and now you've got their attention, and that's where persistence does pay off.
Absolutely. And so as you're getting into this process, I want you to think of it like a sales funnel. I want you to think of it like at the top of the funnel, I've got, say, 200 prospects or, whatever my number is. And my job is to work each of those contacts down the funnel, right? To initial contact, to email, to pitch, to et cetera. You have to think about it in those terms. If you're thinking about it like it's just emails that I send and then I get pitch meetings, it doesn't work like that. Every one of those contacts has to be worked. Every one of them has to be worked.
Let's end with this, Will. What encouragement would you give to all the founders out there that didn't hear any upside to our conversation? For them, it's doom and gloom. They're depressed. And I just want to acknowledge everyone, mental health is a thing. I know founders can get into a funk, especially if you got no runway. You are right at the end. I had a founder email me and say, I'm on the verge of bankruptcy. I have to borrow money just to pay rent because I've been trying to fund my startup. I get it, and I empathize. But Will, for those founders out there going to be listening to this, what encouragement would you have for them if they're like, this sucks. I'm never going to be successful, doom and gloom?
I think it's because you're expecting all or nothing. Like I'm going to go through the whole investment process and raise around or not. I'm going to get it and I'm going to get my product out there and make a lot of money, et cetera. This is a business of micro wins, right? A micro win is I got an investor to open an email, right? That's the micro win. A micro win is I got one more paying customer. A micro win is we got one feature toward, what we're trying to do. There's no version where this just all happens all at once. I think there's often, and I understand it, a lack of patience. When I go to do something new, like a new business, I give myself 10 years to do it, okay? We're in year 14 now of Startups.com. With something like, most founders, when they're building their startup, they're like, I'm going to give this 2 weeks. Ed, when you and I are on Reddit, in the startup subreddit, and we talk to people about how long they're giving to like validate their idea or determine if this is a good business, they're like, oh, at least a couple months. I'm like, I can't think of a single business that was validated in a couple months that became anything, right? And yet there's this notion that I can create magic immediately. It just doesn't work.
I think that's because, Will, we live in the time of social media where everything's just really inflated and amplified. Everybody's living their best life. The founders, they're so relaxed. And that sets up the expectation. And then when you hit the reality, it really gives you a letdown and you get depressed. And so people want it faster and sooner, microwave generation. And that's just not how it's going to work. But at the same time, my encouragement to all of you out there is if you're willing just to be consistently better than average than the next guy over a longer period of time, and you stay in the game, you have staying power, you will eventually be successful. Maybe not with your current startup, but as a founder, you will eventually be successful. I'm pretty sure that's something that we can take to the bank, Will.
I agree. Well said. And I think for a lot of the folks that are listening, a lot of the folks that are raising, it's hard to hear, hey, it's going to take a long time because you need money yesterday. I totally get that. But when you focus on too wide of an aperture where like, I need to make these big things happen right away, that's just not how this works. This happens in a ton of micro wins, like I said. So you need to zoom in on your focus and say, what can I get done today? Today is the only thing that matters. And I'll worry about tomorrow. That's how I've been doing it for 31 years.
Will, this has been a timely topic. Always appreciate you keeping a pulse on what's going on and that we can have these types of conversations That's it for us today. This has been another edition of Startups.com. We've been live. Make sure, leave a comment. We'd love to hear what you think. For those of you who joined us from Startups.com, thank you so much for your support. We are here every Tuesday, Wednesday, Thursday. Tuesday, pitch decks. Wednesday, revenue acceleration, traction hacking. Thursday, we'll be back to answer your questions, talk about these topics. Will, thanks again. I'll see you next week.
Bye, everybody.